There's a book, Stephen Roach of Morgan Stanley and Yale University, The Next Asia, still fresh with updated comments over the years. That looks like, is that the Grand Hyatt Hotel?
Grand Hyatt, Shanghai Pudong. Was there 2 weeks ago.
Been there. We can talk about China, but this is today is a really important day. This is your final day at Morgan Stanley.
I just did the exit interview with some nameless human resources people who thoroughly confused me.
Yeah.
And you know, signed it away, and I'm getting on an airplane in a couple hours. I'm going to do a little bit of Morgan Stanley business in Italy, and that's it.
When did you first walk in the door of Morgan Stanley?
30 years ago, Tom.
30 years ago.
Yeah.
Okay, bring up the Dow chart. Let's look at the equity markets and Steve Roach back a zillion years. This is semi-log. Slope matters, and you can see the long-term regression. We're back to trend. But for investors, Steve, it's been a challenging 10 years. And part of that is they have relied more on economics. And I'm going to say this, you single-handedly invented internet economics. We used to all get our paper stuff. We were drowning in paper. And you were way out in front and said, wait a minute, there's this internet thing. Take us back, what, 10, 15 years, I'm going to say.
1995, September 14th, 1995.
Did like Purcell or Mac just throw something at you?
No. We had discovered maybe a year earlier a new tool called email. I had global people working for me all over the world, but we never communicated on a real-time basis. So I told these guys, I said, every day I want you to write something, 100 words, 200 words. We'll collate it in what we called a group email address, and we'll put it out to the firm. One thing led to another. The clients started seeing it, and we created the Global Economic Forum, the world's first global economics blog, courtesy of the internet.
You can correct me, but I'm going to suggest you invented.
I will never correct you.
You invented a strong and visible discussion of the events. Greg Peters just on from your strategy team. Joachim Fels has a different view than Gerard Minack, has a different view of Dick Berner, now with the administration. Why don't more houses do it the Roach way?
I think they don't really know how to cope with creative engagement, Tom. I learned so much from the debates that we had in the Global Economic Forum. That's what it was. We would pick a theme. We'd take different sides of it. Right now there's a big debate on...
And you would publish it.
We'd put it right out there. We were totally transparent. I think clients are pretty darn smart here. If they get a house view where everybody's on the same page, they go, wait a second, you know, not everybody believes this. And when they would get a view from us, they would see us ripping each other apart, going not on a personal basis, but on an analytical basis to try to understand the building blocks of an argument. And they'd pick the ones they'd like.
Bring up here, if you could, these two charts on the bond market, which span the 30 years of Stephen Roach, Morgan Stanley. This goes back to 85. And it's a 10-year yield, and we're down low. And this is the government, the central banks rather, pushing down yields, the so-called financial repression. Steve Roach, how big is the distortion right now from the Draghi and Bernanke efforts?
Well, financial repression is the right word, Tom. You've got consumers who are not spending. For 4 years, the growth rate of real consumption's averaged 0.5 point a year. They're getting no interest income. They're net lenders to the rest of the economy. And the theory of the Fed is, you know, keep lending rates down, keep funding rates down, because the banks will do the work. I think they're forgetting about the 71% of the economy, which is the American consumer, who desperately needs spending power and interest income.
Do you agree with the academics of Bernanke that says you've got to save the banks, you've got to save the elites within a depression-like crisis? Or can they do a central bank strategy that is more fair for the rest of America, the people that are savers?
The crisis is over. I mean, you know, the chairman spoke earlier this week about he's, you know, disappointed in a sluggish labor market. But the banks that are going to survive have been saved, and it's time to think about producing more normal interest rates that give more normalized returns to lenders.
Here's a 10-year yield. This goes back to when Steve came out of school, 1922 or something. No, but there's the yields going up. There's the Volcker, 1979, and this is, of course, a nominal 10-year yield. Down we go, and you can see that yellow line way over on the right, the massive distortion now. Down near 2%. That goes under zero, which is not right. But you get the idea. Is the great moderation still in trend?
Well, it was never that great, was it, Tom? I mean, the problem with the Great Moderation is that the people who coined the word, our friendly central bankers, actually believed it and tried to convince Americans that everything was fine, the business cycle had been repealed, when of course nothing was further from the truth. And so it led to a lot of complacency, a lot of policy and regulatory ineptitude that smacked us down as harder than we ever thought in 08 and 09.
I want to get to China, but first let's get your op-ed up here on stability and instability. Were you surprised by, and I use this word loosely, by the purge in China? Let's look at the op-ed first. By addressing economic instability through pro-consumption rebalancing and political instability by removing Bao, stability has gone from a risk factor to an ironclad commitment. How can you be so sure of that?
I spent 15 years really studying China, Tom. Stability, at the end of the day, is all that matters, whether it's political, social, or economic stability. And when there's a risk, and there was a risk with Bo Xilai, the government moves swiftly, forcefully to deal with the risk. And yeah, I was definitely surprised. I mean, I was in China when it happened, and everybody in China was staggered at what the premier said at the press conference a week ago Wednesday, and what happened literally less than 24 hours later.
I say I go to China, which is a lie. I go to Beijing, I get in a fancy car, I go to the hotel, I get to the hotel, I go to the fancy office, back to the hotel, back to the car, back on the airplane. You go deeper into China. What's changed in China in the last 10 years when you walk down a given street?
Well, first of all, Tom, you Bloomberg guys have to get out of the bubble. I mean, that's
the surveillance Gulf Stream is a challenge.
I know it's rough, but what has changed is that when you go to central China and actually spent close to a week in Chongqing, where Bo Xilai was the head of the party there until recently, but whether you go to Nanjing, Chongqing, Chengdu, all the large cities in inland China, there's a pace of urbanization, modernization, construction activity, and a much more modern view of China than you will have ever dreamt possible 5 years ago.
Let's look at the
coastal China is moving inward.
Let's look at the GDP chart. I think it's a chart we don't look at enough. That yellow line is 9.5%, the 20-year average, and you can interpret this any old way you want. Don Strasheim has a tipping point of 7%. He's more optimistic than that. Where is your tipping point where they really run into labor challenges if they get softer economic growth? Is it 7% China? Is it 7.5%, as they've stated in their plan?
Look, that's an important question, and I'm going to qualify the answer because it matters whether or not their growth is labor-saving or labor-intensive. Right now, it's labor-saving growth. It's a manufacturing model. So I think anything below 7 is a flashpoint. We saw that 3 years ago in the crisis. The new model, though, will be labor-intensive, driven more by services. I was at a big conference in China. That's all they're talking about now is services. And services in China generates 35% more jobs per unit of output. So they can grow much more slowly and still absorb the surplus labor. And the tipping point in that case would be 5 or 6.
What would you say to politicians in Washington? We've gotten away from we're losing jobs to Asia, we're losing jobs to China, but there's still immense distrust of the Asian economic experiment. What would you say to the politicians in Washington?
Number one, get out of their bubble. Most of them have never been to Asia. They need to see it for themselves. Number two, try to make the distinction between the problems that we have to accept our own responsibility for and the ones we want to blame others for. There's far too much of the blame game still going on today. It's all China's fault when you look at jobs problems or wage problems or other types of difficulties that the U.S. middle-class worker is encountering. I think that's dead wrong.
We talk about Pierre Trudeau there, and the idea of the certitude of the moment, which was, oh no, we're all going to be beholden to OPEC, and yet there's the technology of hydrocarbons, the boom of Canada, the boom of North Dakota. How do you, within your study of economics, try to keep up and try to stay away from consensus?
Yeah, that's a great question, Tom. I mean, I think there's no substitute for, again, analytics and trying to have a framework that enables you to not understand the past, but use the past as a tool to glean insights into the future. So you see things going on like, a series of energy shocks that takes oil from, 4 to, where we are today.
Right.
And along the way, you've got signs that businesses and consumers are feeling pressure and are reacting. So you try to anticipate the technological forces that drive that reaction. Same thing with the internet.
I would go, as price matters, as oil prices moves, things change. To Dick Berner's work when he was with Morgan Stanley, these microeconomic foundations of all the blather we do every day about the big picture. Why have we had such a problem clearing this financial crisis? Why have we had such a problem clearing the housing crisis, just as one example?
Well, my nickel for what it's worth is that despite all this, QE1, QE2, twist, maybe QE3 or twist 2, whatever you want to call it, that the problem is no longer the financial system. The problem is the American consumer that was obliterated by the bursting of the biggest bubbles we've ever seen. And consumers are not growing, they're not spending. And so I think we're looking at the wrong dimension of the problem right now. We don't need to inject more liquidity into banks who are unable to convince consumers to borrow. Consumers are paying down debt. They're rebuilding saving, and they're not spending. The growth rate of consumption, again, 4 years in a row, average annual rate 0.5%. We need to look at that. What is it going to take to get the demand problem addressed?
Do you go back to a traditional
US?
Keynesian model, or do you have to find a different model? 1936 doesn't work, or Krugman's 1939 with Hicks, they don't work anymore because we're a global economy.
Look, consumers are in a balance sheet recession. Look at the work by Richard Koo, for example,
right,
who studied it with respect to China. When you blow up the balance sheet the way we do, the natural response for Japanese corporates and now American consumers is the so-called debt rejection syndrome. They're paying down debt. Maybe you need to accelerate the process through some creative form of debt forgiveness to get that process more further along.
Okay, I want to show this one chart. This is the distortion out there. We've shown this many times. The greatest distortion, this is just trade-weighted Swiss before they pegged and it's moved on. It's a medical chart, folks. I mean, it's a hockey stick of the distortions of Europe. What is the Roach prescription for Europe? Then we got to go.
Look, there's no easy answer for
Well, Joachim
Europe.
says there's complacency.
Well, but that's a diagnosis, not a prescription. And Europe clearly has thrown a lot of liquidity at the crisis. But what have they really done structurally to address the rigidities, the lack of a fiscal leg to the stool? That's still an answer, Tom.
Okay, well, we're going to have to go. Steve Roach, congratulations on a terrific career inventing a lot of market economics at Morgan Stanley.